The key is essentially an asset quality. The view has to be an asset quality because that was what was driving the negative outlook in the first place.
Right.
So what we are saying on asset quality is that we believe we are closer to the bottom. What do we mean by that? It's not that the stock of NPLs has peaked out. We think it will keep going up. But the pace of addition we think will meaningfully come down as compared to the last few years. And we think that's an important event enough that's important enough for us to change the outlook.
All right. So can you give us some numbers on how the additions are coming down compared to the others? What is your outlook for this financial year and the next?
Sure. So just to give a perspective, for the year ending FY15, for the 11 rated public sector banks, we estimate that the net new impaired loans was around 120,000 crores. They added 120,000 crores of new stock of impaired loans. And that was broadly the run rate that we have seen over the last 3-4 years. That number we think this year would be closer to 80,000 crores. And obviously next year should be even lower than that. And that is what has led to our change in this outlook.
All right. Wanted to understand, there is also under recognition, especially when it comes to the private sector banks, when it comes to impaired loans and even NPL situation. Don't you think that will also add a lot more going forward? When push comes to shove, then definitely that will have to be recognized.
Okay, I think we should be very clear. Even when we talk about 80,000 crores adding this year or something lower adding last year, all of that is because of under recognition. It's not because of any new problems coming in the economy. So we cannot look at under recognition and what we're estimating as two different items. It is because of under recognition that we are saying that the stock the pace of addition while coming down will still be a meaningful amount. Now coming to the private sector banks. Now the under recognition is not because of specific bank issues, it's actually more sector led. So if we look at our overall coverage, we think the key sectors where there is under recognition, that one that really stands out is the power sector. Right. And on the power sector, we believe that even private sector banks, whoever has exposure to that sector, we believe there is an element of under recognition because essentially they have lent to the same projects. Right. Where there is a difference is how important is this sector in their overall portfolio. And that's a key difference compared to the public sector banks. Because 40% of the loan book is retail, because their corporate exposure as a percentage of the loan book is much lower, while they have exposure to the same troubled sectors, the amount of under recognition as far as overall portfolio is concerned is lower. That is only the saving grace.
All right. Apart from the asset quality, what are the other factors? Because you did clearly say that operational environment is improving. What are those parameters that you have looked at and how are they improving and based on what factors?
I mean, if you look at the operating environment, if you look at the GDP growth, if you look at some of our leading indicators we look, which is something like the index of industrial production, if we look at the investor sentiment, for instance, and in that the movement in the currency actually stands out, where during the recent emerging market scare, the Indian rupee actually was one of the much better performing currencies. So if we look at all these factors and we look at some of the policy announcements, some of the policy action that is going, we are definitely seeing the trend is towards unambiguously positive. Where there could be an element of debate is the extent of improvement, is the pace of improvement. And there clearly there is one step back and one step front sort of mechanism. But we think the direction is clearly positive.
All right. And what about capital requirements, especially the PSU banks? Now, how do you see the Indradhanush really panning out? And is that really enough for the banking sector?
I think we need to segregate two very distinct things when we are talking about the public sector banks. One is the cyclical issues, which is basically that there have a lot of NPLs and they have very little capital. Now, this can only be solved if it has to be solved very quickly. Let's say if it has to be solved within 6 months or 1 year. The only way it can be solved is by giving them a lot of capital and enabling them to clear the balance sheets. Now, Indradhanush, in our perspective, actually is looking at structural issues. How to improve the corporate governance, how to improve the board accountability, these issues. Now, these are definitely very important issues, but the impact of these issues can only be seen in the medium term. I don't think it's possible that any of these Indradhanush initiatives, other than capital, can really make a difference in the very near term as far as the asset quality and capital issues are concerned.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.